We've known each other. I was thinking back something like 20 years. We both went to UC Davis. We lived in the Reno Tahoe area. I have been following your work for a long time. You've been helping investors navigate uncertainty, is what I would say, yourself and people who follow you for decades. But I'm really grateful to have you here. I'm currently inside of using your models in my investing. And I am really excited to have you talk about the fact that they're doing so well this year in this experience of great uncertainty and instability, I would say. And so, what I wanted to do was, I've got some questions prepared, but I would love it if you could introduce yourself and bring people up to speed with who you are and what you do, and then we'll dive in.
Yeah, so my background, I was one of the early pioneers of computerized trading systems. And so to put that in context, obviously I'm an older guy. Um, so when I graduated from college, they were just coming out with the first Apple PCs, and IBM had the PC. It was an old 8088 processor, and if you had a 10, what was it, a 10 megabyte hard drive, you had a gargantuan hard drive. It was just, those were the days. And so I was hand programming trading systems back then. I had this crazy idea in a college investments course. The professor was well known, highly respected, it's accomplished investor. And so he was walking the talk. And so I respected him. And I'm looking at this investments course manual thing and a bunch of charts with squiggly lines and everything. And I went up to him after the class and I said, Professor, pardon me, this seems to me like I can make money off this without knowing anything about it. I could just apply statistics to it and I would make money. And he goes, well, you can't do that. I go, well, why not? He says, well, nobody has. It's never been done. Again, this is before widespread use of computers, right? Now, of course, nobody would say that now because it's commonplace. But back then, he said you couldn't do it. It was impossible. So then I went to my father, who was the only other investment authority I had, and he basically said the same thing. It's never been done. You can't do that. It's not how it works. And I've been dealing with that response ever since. And of course, it works. I founded a hedge. Not, I didn't found. I was a partner in a hedge fund, and we did all quantitative model trading, and it worked. We had, God, what was it? 12, 13 profitable years consecutive, no losing years. We traded through, nuclear explosions, Chernobyl. I never forget that day because it was my first $100,000 loss day in the futures market. Um, because it's what's called a UFO, unidentified fundamental occurrence. When a nuclear disaster occurs and it's upwind of all the wheat fields and everything in Ukraine and all that, it just blows and all the markets just went crazy. You couldn't get out of the markets. It was all lock limit. Anyway, I'm off track. So I had the hedge fund. I developed a bunch of models, did a lot of research. I basically created a thing called Todd's $100,000 garbage pile, which is my job was to find everything that was ever kind of created on the markets and put hard numbers to it. So I just did research and research and research, and surprisingly, almost nothing beats buy and hold. There are a few things, though. The key word in there was almost nothing. There is a commonality in the models that do beat buy and hold, and that's that they have greatly superior risk management. And that's the fundamental flaw of conventional investing that most people don't understand is that the game is a balance between offense and defense, and they don't have very good defense for most investors. So anyway, I did the hedge fund. We sold that. I quote air quotes retired. I decided that I really wasn't done with finance investing. It's my passion. I was still reading books on the subject even when I was quote unquote retired, just because I'm fascinated by it. And so I launched a financial education company, which you're aware of, financialmentor.com. And in there, I have a course called Expectancy Wealth Planning. It's the only course ever created around mathematical expectancy as the foundation of it. So you start from the math of how wealth accumulation works, and then you branch out and you build from those math principles to apply them to life principles. And so I created that course. I mean, the reviews speak for themselves. It's changing people's lives. And then I fell in with Allocate Smartly, which is what we'll end up talking about. And that became a solution to a different education process I was going to do, which was expectancy investing. I used to coach clients one-on-one around expectancy investing and educating them all around mathematical expectancy, how you apply it to investing, and what are the principles, what's true in common wisdom, conventional wisdom, and what's false. It's about half-half. Conventional financial wisdom has it about half right, and they've got it about half wrong. It's close enough to right that it passes most people's smell test, but there's some key things missing that point a different direction of understanding. So I used to teach that course, and it was very difficult for clients because applying it was really hard. And what happened was when I ran across Allocate Smartly, it made application super easy, such that I didn't even have to teach the course. I just had to teach them enough to use Allocate Smartly intelligently, which is what I'm doing now. I'm building out 2 courses for Allocate Smartly, which is what people who use my affiliate code they get. And I don't charge for them because I get paid by Allocate Smartly. So
Oh, that's so interesting. I've been writing to you, especially since signing up. I think I came to you back before the election, and I was really tired of just all the different things that I had done in my own investing, having been an advisor, having worked in finance for 30 years. And I knew that you had been talking about what is happening right now for many years, to the point where a lot of people didn't agree with your philosophy, but yet there you were, and you were in the back of my mind, and I'm like, this is exactly what Todd's been talking about, and maybe we'll get into it. But I want to say
well,
that,
you're talking about the epical change call, correct? With
yeah,
the epic, we
exactly.
changed the epic of investing, epoch. Some people call them epochs. Or in common parlance in the business, it's called regime change.
Regime change, yeah. And I did a video for this channel, I don't know, 6 months ago, about the fourth turning is here. And so some of my followers have seen that video. And
Mhm.
so that
Yeah, it's good
also
stuff.
dovetails into kind of what the heck is going on, and why is the normal not acceptable, at least to me and to many people who understand that things are changing, that don't that defy the old rules. And they have been happening for a while, but a lot of people are slow to change. So I'm
Oh,
just going to
incredibly
give
slow
them
because they
the
haven't been beat
benefit.
up yet. Most people will change after they've lost a lot of money. Very few people will proactively change.
Yeah. And
They'll
maybe,
switch horses after the horse leaves the barn.
yeah. I mean, there's two things. One is, my audience, they're not, for the most part, sophisticated investors. And I know that people find me through YouTube who may be, and they're watching this conversation because they know you. But I want to try and keep it as basic as possible, because the thing that concerns me is that what we're about to talk about, everyone should know about. And just because you don't have a broad, extensive background in finance does not mean that you can't do what we're about to talk about. Is that
Yeah.
fair?
Yeah, totally. I mean, you've been through it now. It takes a couple weeks to kind of wrap your head around it, a part-time effort. It takes a couple months before it becomes a pattern. And after that, it's easy peasy,
Totally.
because it only takes like 30, 45 minutes a month and it's easy to do and you're in charge. But I want to touch on fourth turning. So yes, it is easy. People think it's hard, but but it takes some effort. It's not effort free. It's not like passive buy and hold where you do literally nothing,
No,
right? So there is a little bit effort involved, but what you get for that little bit of effort, I think is well worth it. I couldn't think of it any other way. But I want to touch on the fourth turning thing. So, because I talked about ethical change, I've been talking about for a while. I first announced that it would occur during the COVID stimulus within my private expectancy wealth planning community. I told the community, I said, it's going to take a lag, but I said that the government touched the third rail with printing money. So if you look at the history of the Fed, the history of the Fed's gone through three levels. They got three tools they can play with. And so the first one is interest rates. That one they can play with impunity as long as they got a deflationary backdrop. And they did. But once they got interest rates too low, they couldn't get the effect they needed with the amount of interest rate movement they had remaining. So they went into QE and QE, not QE, you know? So they started moving all the QE stuff. But there's also a limit to how much QE you can do. And so once they started hitting the limits of the effectiveness of QE, then they moved to the third rail, which was outright quote unquote printing money. But in the digital world, it behaves a little differently. They're not actually going burr with the printers. It's a little different. But when they did that to direct fiscal stimulus, I announced to our community, I said, it's done. That the epoch will change now. We will get inflation. Inflation will be systemic. It will not be cyclical. It will be systemic, and it will do it with a lag. So you don't have to jump ship yet. Okay, it's not time yet, but I'm telling you, this is what's going to happen. The Fed has played all its cards. It's at the end of its game. And they've shown their hand by how they played their cards. They were desperate in COVID and they played direct fiscal stimulus. So I'm not here to say whether it was right or wrong. I'm only here to look at the facts and point out what's true or not true. And so around fourth quarter, I think it was, yeah, Q4 2021 is when I finally went public in the newsletter and I said, lag's over, it's here now. And so I went in the newsletter and I said, the investment epic has changed. What you knew for the last 40, 50 years is over. Everything you hold true, everything you believe of how the markets work and how the Fed works and how everything's going to play out is over. That game's done. It's been played. That hand is fully played. And much of what drove that hand has now flipped upside down. And it's driving a whole different game now. And so you're either in front of it and you know what you're doing and you know an investment strategy is going to work for it, or you're behind it with a lag and it's going to hurt you and you're not going to make a change until it's after you've lost a lot of money. And so, and what I've said is that it's not that we necessarily have to have massive losses, but we will have massive losses in terms of purchasing power and time lost. And so, what I pointed out is I said, the net result that you can have confidence on, I can't predict the markets. I don't know whether they're going to go up or down next week or next month or anything like that. I don't have a crystal ball. But we do know is that in the next 10, after 10 to 15 years, you will have no net return in your portfolio net of inflation. So if you're fine with that, if you're fine with looking at your portfolio 10, 15 years later, you endured all this volatility up and down, and you have nothing to show for it net of inflation, because you could have gains, but they could all be inflationary gains. Your purchasing power is going nowhere, right? So I said, no net gains net of inflation 10 to 15 years from now. If you're okay with that, fine, enjoy. I'm not okay with it. And so I put together the package that we'll talk about in order to help people do something that will actually work in this environment. So
To me,
in a nutshell, I just want to point out because
yeah,
I got off track there. Fourth turning is one aspect of it. Okay, fourth turning is the social dynamics and the generational and the population dynamics. Okay, where I came from when I made the call, and the reason I was telling that story, I came from market dynamics. So we went to a thing of peak market valuations, historic peak market valuations, historically low interest rates. Those time series are mean reverting. They will go back. It's only a question of time. It's not a question of if. They've been mean reverting their entire history, and they are at the extreme of extremes of extremes. Okay. So
explain that in basic language.
the value of any asset is discounted present value of its cash flows. And so when you get to maximum valuation, what it means is that the discounting mechanism is reflected in a maximum price for the cash flows that are provided. And that's also done off of peak earnings and all these other things. And so what happens is if you break the numbers down, you'll go to a peak of a peak of a peak. Like it's the highest overvaluation in all of recorded history, greater than 2000 top, greater than the Great Depression, greater than the 21, 22 top that preceded it. And so, and then interest rates, obviously, they went to ZIRP, right? Zero interest rates, which is unprecedented. Some of them even went negative. This never happened in all recorded history. It doesn't even make sense. You can't have negative interest rates or zero interest rates because time has value. It's violating a fundamental law of economics to do that. And yet they didn't because they're artificially manipulating interest rates to try to create fake prosperity. And so when you get to these extremes, I call it extreme point analysis, when you get so extreme that it's absolutely unsustainable, it's a rubber band that's pulled so tight, and when you let it go, it snaps back, right? So any gains that would continue from that point are on temporary. They will all be given back. There's no mathematical way to win. And so, like,
Yeah.
give an example, okay? In 2013, if you go on my website, I have a post called The Bond Bubble is Here, What to Do Next. I published it in 2013. 2013, it's still on there for posterity. I haven't changed a word. All I did was put a little intro in it, giving the date of when I published it and why I'm leaving it unchanged. And I said, and I went through the math of why bonds are done. You cannot allocate to bonds long term as of 2013. There's no math logic to it. They can't have, it's impossible for them to have any return net of inflation. And so it's only a trading position from here on out. You can use it to trade interest rate moves, but you cannot have it in a buy and hold portfolio. And I was taken out to the woodshed and beaten with that one. People are like, you can't, I mean, it was sacrilegious. You can't
Yeah.
do that. You can't say that. And of course, you got to understand this back in 2013. Like, this is before any losses were occurring. People were making almost as much money in bonds as they were in stocks.
Right. I remember that's when I was an advisor and I had people I was working with, they only sold bonds.
Yeah, and they were inversely correlated with stocks during downturns because it was a disinflationary environment. So every time you had a downturn, the Fed would ease interest rates, which would mean bonds would go up. So they're acting as a ballast to stocks during downturns. It was a dream portfolio for a dream time. And along comes this crazy guy called Todd and says bonds are done. They can't have any positive mathematical expectancy net of inflation for any foreseeable future. And I said again, I said like I just did now, 10 to 15 years, but
Yep.
we're 12 years in. It's already fully correct. Probably going to be true for the next 10 years as well. Zero expectancy or negative expectancy bets, they can only be a trading position. You cannot have a fundamental asset allocation position to them for the long term.
And this is stocks, what's happening to stocks right now,
Yeah, it's true for
essentially.
stocks right now. They're so overvalued that they have a negative expected return over the next 10, 15 years.
Yep.
Right? So that means, yes, they will have trading returns. They will go up, they will go down, probably quite violently. But net, 10, 15 years from now, you're going to look at your portfolio and go, wow, all that volatility, I got nothing to show for it. Trading position, it is not a fundamental position. Now, I'm not anti-stocks. They have a
Right.
role in the portfolios that I've designed. They're extremely valuable. They're a risk-on position in proper portfolio design. But just understand, they're not a buy and hold asset, which
Hmm.
is shocking to most people, right? Most people have a buy and hold portfolio of bonds and stocks, and they're both negative
Exactly.
expectancy assets right now.
Most people are so trained to just follow the leader, and the leader isn't talking about what you're talking about. And because they don't understand it, they put all of their eggs in one basket. I know what I was going to say. They were talking about the fact that a lot of the big market movers are already following things that you are doing. Whether that's true or not, that's what they said. But it's the majority of the stock market is made up of people who don't understand the stock market, and they're putting all their money, everything they've got. They're exposing themselves to way too much risk without
Well,
understanding what the risk
going
is.
going back to your comment about fourth turning, and I was saying that there's three prongs in which you look at it, right? One is the version of the fourth turning, which is very well done, highly recommended. Neil Howe did a great job with the work. Okay. And then the part I was talking about, which is understanding extreme point analysis and market dynamics and different market cycles. Okay. And so what's even possible? Like you look at and you it can go so far, so extreme that it's mathematically impossible. Like it's just you can state it. I can state these extreme crazy positions because they're just math facts, right? They're not even extreme crazy. They sound that way. I could write that thing in 2013. 12 years later, it's spot on dead right. I can make a call for epical change back in 2021, fourth quarter 2021. We're now 4 years later. It's spot on correct. I mean, Trump wasn't in office back then. We didn't have systemic inflation back then. We didn't have all the international turmoil back then. We didn't have any of those things going on. Everybody thought it was just more of the same, party on. We're all going to have fun, and this thing's all going to the moon. And along comes Todd and says, the epic change, guys. You got to change it now. 4 years later, it's obvious it's correct. And yet people are still stuck. So it's not like I'm making these crazy calls out of nowhere, right? There's a history of this stuff and it's accurate, and there's a track record that shows it's accurate. So the point I was going to make is that you're talking about people remain stuck. And there's another aspect, that's the third prong of this, which is societal dynamics. And right now we have such extreme speculation and financial nihilism in the younger generation that it's it's changed market dynamics, right? So you've got people chasing the last dream with, tech stocks, and which is often a harbinger of a final top is the tech stocks. But anyway, um, you've got the financial nihilism of hopelessness. If you're not going to get 100x, it's not, 100 times your money. Why bother? Which is where all the crypto craziness comes from. And so, and by the way, I'm not anti-crypto. There is a there, but there is no fundamental valuation to cryptos of now because there's no real business use yet, right? So it's
Mhm.
all pure speculation. They can go to zero and they can go to infinity. It's all the same thing because it's a purely speculative asset based on liquidity. That's why you see it correlating with the NASDAQ highly, because mostly driven by tech bros and people with tech interest, and it's driven by liquidity. And so your high correlation is going to be with the NASDAQ. So it's not the new gold, like people like
Yeah.
to say. That's pure nonsense. It doesn't trade like gold at all, right? It has none of the same characteristics, but people try to collapse it because of quote unquote limited supply. Get into three prongs. The
Yep.
social dynamics, which is why we have what we have right now.
Yeah.
You have to have the social dynamics to drive the valuation numbers and the market numbers to insanity, and have people not even aware of it. They're just looking at it not aware because they haven't studied economic history to have the context to know when things are out of whack.
I've known things are out of whack the whole time throughout, I think, since I got my MBA in the early 90s because of fiat currency. It's a whole other conversation we could go into, but like I did understand that it was a disaster waiting to happen at some point because currency that's just backed by the government with the ability to do whatever the heck they want. I mean, which is kind of what they've been doing. It doesn't make sense. Like from a very grounded place, it doesn't make sense. I know it's
Yeah, if
worked.
you give, well, if you give politicians the ability to spend to buy votes, guess what they will do? Will spend to buy votes. And if when you're in the United States, you can run up the debt and the deficit to pretty large numbers, profoundly large numbers, because of the good faith credit and dollar dominance that the US presents. And so the politicians that could spend freely, they did because they're just kicking the can down the road. They're there for 4 years, 8 years, 12
Yep.
years, whatever the number is. They're there temporarily, and the problem will be later. It will always be later after they're gone. What they care about is now to buy the votes. And what does population want? The population wants an immediate response now, economic good now, right? And I'm not
Yeah.
making a political statement with Trump, but if you look, he's
No,
doing the exact same thing, right? He's trying to create
totally.
economic stimulus now. He has to have it before the midterms, right?
Right.
You're going to end up with a problem down the road. And the problem is it's now. In other words, the debt and the deficit are so large that they are a major determinant of government policy now. So it's gone past the thing of kicking the can down the road, and it doesn't matter. It only matters 4, 8 years from now, or sometime in the unknowable future, which is what it's always been for yours and mine's adult lifetime, which is
Right.
a long time, right? They've just been compounding it, compounding it, compounding it. Well, it's here now. Okay. The problem is now you can see that in the Trump administration's policies and how they are just scrambling to get liquidity. They're trying to do it through adding stable coins, which will create implicit demand for treasury securities. They're doing all kinds of stuff to try to get demand for their treasury securities so they can stay liquid and not have this thing implode.
I, I do want to talk about the social issues for a second. And I know I had some questions, but this is really, really good what we're getting into. So I'm going to trust that in the process. I want to say this part of the reason I reached out last fall and I took all the time to learn the models and implemented them. And I want you to talk about a little bit about how they work is that I do not I intuitively know we're, if you look at the fourth turning is here, we are at this change societally, politically, like all the stuff that I want to spend a lot more time thinking about, how it affects my children and my children's children and the social impact of what's going on. Like that would be my top priority. I also, because I have built wealth and my husband and I are semi retired, I want to not have to think, okay, when this falls apart, all my money goes with it. Like, I'm just going to be really clear. Like, I want to make sure that I'm making good choices in the context of a system that I see collapsing. Is that a fair statement? Does that make sense to you? I guess I'm not
I understand where
alone.
you're going. Yeah.
And I think it's interesting because what you offer to your community, regardless of what their priorities are, some people may only care about the money. For me, I care about like, what's this world look like? And how can I make a difference using my wisdom, my knowledge, my voice, my privilege, what have you? Like, but if my money is the thing that I'm focused on all the time, I'm not going to be able to focus on the things that I think I could really do and making a difference in the lives of others. And so everybody's got different reasons of why it matters that they understand what's going on and what how their money needs to be managed and treated. But I just want to say that because that's why I think I'm such a fan of what you do, because I didn't have to follow this buy and hold, everything's going to be fine, even though you don't think it's going to be fine. And you're giving me another way to manage my money, knowing that it is likely still that things are going to collapse, but my money doesn't have to go with it. Yeah. Anything you want to say to that?
Well, I mean, there's a couple layers in there, right? One is you've got the financial dynamics. The other one is you've got the social dynamics of what you want to do with your life and what your life truly means to you above and beyond money. And then you've got how do I manage money to keep things afloat and not get taken down. Um, where they connect is that if you can manage the money efficiently and effectively, then it doesn't have to distract from the rest of your life. If you
100%.
botch up your investing and you lose half your portfolio value, or the value just gets diminished over time due to inflation and poor performance, um, that's going to affect everything over on the other side of quality of life, what you can give back to others, what you want to do. The beauty of the tactical asset allocation, as I teach it, as we said at the very beginning, it takes a little bit of effort to wrap your head around it. There's a lot of models on there. You have to pick your models. You have to set up your portfolio. You have to get used to doing the updates once a month, right? You have to update your portfolio once a month, but it takes half hour, 45 minutes. Is that fair? It
Yep.
takes about a half hour, 45 minutes. So, it's a couple weeks to get used to it and then a couple months to get down the pattern to where it's just a straight pattern and you know what you're doing. And then after that, it's half hour, 45 minutes a month. And what it gives you is vastly superior risk management. The problem with conventional asset allocation is it assumes that every time is a good time to be fully invested, which is patently false. The quality of, or I'm sorry, the mathematical expectancy of your portfolio is a function of several variables. And as those variables change, the expectancy of your portfolio, the expected return of your portfolio changes. And so you need a disciplined method for adapting your portfolio to those changes in real time and not being behind them. And so that's what the better tactical asset allocation models, there's some lousy ones too, ones that I would never put a dime on. But the better ones are very good at adapting in real time, and they constantly are aligning your portfolio as the dynamics of the marketplace change. So they're never very far from right. They're not perfect. There's no perfect investment solution. They can go through whipsaw periods. They can go through periods of underperformance relative to the benchmark, which would be buy and hold, right? Passive index buy and hold. We would deem that the benchmark, and tactical would be the up and comer that's trying to beat the benchmark. There are times when it'll lag, but over time it pretty reliably beats the benchmark and with a tiny fraction of the risk. And there's reasons why that's true. And there's reasons why you would expect it to continue. But most importantly, in an environment like this, where the downside risk is measurable, it's that's the wrong word. The downside risk is knowable in advance, statistically valid, with high confidence, and you'd be crazy to bet your fortune on it. I mean, it's
Mhm.
just, I couldn't sleep at night if I had a conventional portfolio. Now, it won't be true all the time. There'll be a day when valuations are very low. There'll be a day in the future, sometime during my lifetime, hopefully, that I don't kick the bucket too early or something. But someday in my lifetime, there'll be single digit stock market valuations, you know, double digit dividend returns on stocks and fair market returns on bonds with inflation under control. Um, and a passive portfolio can make great sense then, just as a passive portfolio made great sense in the past. It's just time is not now, and it's not for the foreseeable future. There's clear indications as to why one needs to better manage risk right now.
A lot of people have financial plans and they've got, let's say, 2 or 3% inflation over the next 40 years, and they've got the 8 and 9% returns in their stock market put into that plan. Like, the plans change a lot when inflation goes up, and you're, like you said, stock market doesn't actually net much of a return, if any.
The way I teach it in my expectancy wealth planning course is there's two numbers that matter in wealth planning and financial planning. Um, you go to a planner, they're going to ask you a million questions about all this detail and all that. And you can add it all in and it increases the accuracy of the calculator, but it's tiny, right? There's two numbers that make or break your outcome. One is your savings rate as a percent of your income in the early years. The early years, your wealth growth is determined by your savings rate as a percent of your income. And in the later years, it's your compound return minus inflation. And so the numbers you just gave created a gap, a spread of 6 to 7%, depending on which of the numbers you were using, which is a big compound return net of inflation historically and quite optimistic. And yes, there are a ton of plans designed that way. Um, if you run tactical asset allocation, it gives you a higher return expectation. I've taught my students to temper it because the historical data they're using is biased, right? Because of the long bond bull market, the long stock bull market, because interest rates decline from 20% down to zero over a period of 40, 50 years. We aren't going to replicate that in our lifetimes. It may
Mm-hmm.
never happen again. Okay.
Mm-hmm.
So anybody who's building their portfolio design based on something that absolutely cannot occur again, right, in their lifetimes, and is likely to do the opposite is kind of crazy, right? That's a false set of assumptions. So I teach my students to focus on the right things at the right time in their equity career because I have young students, I have people who are just out of college. So I'm teaching them about how to focus on their savings rate, focus on their career growth to increase the amount of income, which increases the spread while controlling expenses. All the strategies, get your real estate early, get rental real estate early, and there's all these strategies that are applicable for somebody young, right? And then for somebody older, it's all about compound return minus inflation. That's where the tactical comes in. It gives you a higher expected return and it's more reliable. And most important for a retiree, and this is the game changer, is it virtually doubles your safe withdrawal rates from passive. And there's a reason why that's true. It's not that it's because the return is so high, it's because the reliability and consistency of performance, right? So you
Mm.
don't go through extended drawdown periods where you're spending from the portfolio in retirement when the portfolio isn't earning anything. Typically, better systems are 2 to 3 years to making new highs to recover from drawdown periods. That completely changes the game of spending from your portfolio. So
Mhm.
for people anywhere near retirement or considering retirement, which is most viewers, it's a game changer.
What I was also going to ask you is, we're making the assumption people are investing. I know plenty of people who are so scared about what's going on that they're in heavy cash positions. Even a lot of these very sophisticated investors are like, we're in cash, we're waiting, we're doing what Warren Buffett's doing. Like, can you talk about why that is not what you're doing with these models right now?
Well, it's making the same mistake that a buy and holder is making, right? They're just buy and holding cash. You're making a bet that that asset will outperform inflation over time, over the time period you hold it. Um, excuse me. And so cash over time is not a wealth builder, not a wealth creator, and it doesn't support spending in retirement. It's designed based on interest rates, assuming the government isn't manipulating them too heavily, to basically have an interest rate that offsets inflation. But that's not going to build wealth or support spending in retirement. So the way I teach it is you have to have both a good offense and a good defense. So you have to have an offense to capture expected returns when opportunity presents, and you have to have a defense to guard against losses during periods of adversity because the math of compound returns is unforgiving. It's I call it asymmetric math without getting too geeky. I'll just go through it really quick. A 10% loss, it takes 11.1% to get back to even, right? Because you go from 100 down to 90, 11.1 on 90 gets you back to 100. So then you go 25% loss, it's 33% to get back to even. Notice it's spreading wider. 33% loss, it's 50% to get back to even. 50% loss, 100% to get back to even. So the gap keeps widening the greater the loss. There's kind of a point of no return that messes up portfolio compounding, and it's somewhere in that 20 to 30% range. If you do model development, you'll find that you mess up the compound return of models once you allow risk to exceed about a 20 to 30% loss. Now, of course, buy and hold, you by definition must accept at some point a 50% loss to get a market return, which is a horribly unfavorable risk to reward ratio. But that's what history shows is true, and there's no reason to believe the future is going to be any different. And it happens with some regularity. And so you have to be willing to endure that 50% loss. The problem is when you do that, so it's already happened in bonds. It happened in bonds in 2022, right? We're just waiting on stocks. And so it's not like, again, this stuff sounds crazy when I say it. People think, God, this Todd's a nutty guy, or all this stuff happens. I said epical change back then. We had a 50% loss in bonds. Like, you know, people would have said this impossible. No, it's not. I wrote about it in 2013. When you get extremely small interest rates, the leverage on that interest rate to create capital losses is extraordinarily large. Coming off those historic lows in interest rates, you are mathematically certain to have a historic loss in bonds. Again,
Hmm.
it's right in the post in 2013.
Yep.
It's not like I'm saying this with
Like,
hindsight.
we're talking about these times that we're in right now, where the market's been all over the place, lots of different things happening this year. But you've been creating and working with these models for, one question, how long? And even though the buy and hold people would have done very well, let's say overall, especially since 2010 when the market was like way far down, how have how did your model do even in not crazy times? I'm just curious
They
because I
outperform.
they outperformed. Okay.
Yeah.
So it's not like people are making a choice to do something that didn't do well. It's like it did well in good times, and it's doing well in really crazy times. And that's because you had happened upon that there was a way to do it
Yeah,
successfully.
the reason it's not common knowledge, there's a couple different bases of knowledge you need to put this together correctly. You have to know the financial markets very deeply. You have to understand how the financial markets behave in a variety of economic conditions. And then the other thing that you have to understand is mathematics intuitively. I'm not a math genius, but I have an intuitive understanding of mathematics and how the numbers work. Like I'm better with numbers than I am with language. And so, which is funny to say for a writer. But but anyway, and so there's that, and then there's also system dynamics. You have to understand system dynamics. So like if you change something, it can fundamentally change systemically how things work. So like you could take it in health, right? We're both getting older, at least I am. You obviously are not. And so
Oh no.
we've got, the joke is health is the absence of concern for it. As you get older, you have more concern for it because you can tell you're getting older,
Yeah.
right? Things
Yeah.
just are changing. And so system dynamics are such that understanding health, it's an entire integrated system. It's not, you can't just plug a hole. You can't just change one thing. It's all systemically changing, right? So I'm using health as an intuitive example. It's the same thing in market models. So like in the free course that people get if they subscribe using my affiliate link, which you received,
Yep.
I go through and I take apart every model, right? I go through and I explain because there's like, I don't know, what, 60, 70 models on the platform.
A lot.
Yeah, it's
Yeah.
extraordinarily confusing for somebody that doesn't know this stuff inside out, right?
Hmm.
So I spent weeks going through every model in excruciating detail. And then I
Wow.
did these really quick write-ups and I'd say like, these are the pros, it does this and this. These are the cons. And I would green light, yellow light, red light, right? So red light is it fails risk management criteria, or it has some fundamental algorithmic error in built-in design, and it's going to come back and bite. And so it helps guide people to find intelligent choice models. And as you and I were talking off camera, I have two models on the platform, and only two. Those are the only two I put on the platform of my personal models. One is the top performing model over the last 40 to 50 years with nothing even close. Like the next closest model is an over optimized model. It's all done off of historical data. Mine's not optimized at all. And I think I have a Sharp of 1.2 something, and the next closest Sharp is like one.
Hmm.
And a Sharp over one is almost unheard of, by the way.
Totally.
Yeah, it's extremely rare. I think that model is one of the only ones on there. And then I have another model which is more volatile, so it doesn't give the same Sharp, but it has a higher expected return. It's fundamentally a different model. They're really good to combine them, and because they behave differently in different market conditions, they're made to work together. And that second model is if it's bouncing around as the top performing model this year, it's like sometimes it's the top three, sometimes it's number one, sometimes, but it's been around one of the top performers this year. So those are my two models, top performer long term, top performer this year. And then like in that write-up, again, that write-up was done back in what, 2020?
Hmm.
And in there, I talked about the bond market bias in the models. Do you remember that? I went
Hmm.
through all the models and I would redline the ones that had a bond market bias. So back then, model creation, because there was a long 40, 50-year bond bull market, which was built into the data sample. And I knew it couldn't continue. And so I was pointing out, no, this one has a bond bias. When it goes risk off, it goes to bonds. That's going to bite them in the future when interest rates are rising during a decline. And it's going to happen at some point in the future. I just didn't know when. Well, it happened the very next year. Right?
Hmm.
So the very next
Hmm.
year, like a major chunk of the models on the platform blew up. Well, if you look at my write-up, which was done in advance, not hindsight, I went through and I eliminated all those models.
There's two parts to potentially working with you. There's the class that you referred to, and then there's going in and buying a membership to allocate smartly, and then learning about the models, and then learning how to implement them and all of that. But when somebody buys the workshop with you, which I've watched many of the modules because you make them available to people for a certain amount of time where you can go in and see some of them. And so I've seen a lot of them, and the classes are incredible. But you also have a community that people get access to so that they can ask questions and get
Yeah.
assistance as they're learning to allocate smartly. Is that part of the class?
Yeah, so let me just differentiate it here. So there's
Okay.
two ways to quote unquote work with me. One is expectancy wealth planning. So it's a master course on financial strategy, wealth strategy, right? And it's not a geek course. Like normal people do it. They get it,
Yeah.
right? I go through, I explain everything, I build it all brick by brick
Yep.
meticulously. Um, and what you're talking about is the free test drive. So you can get 5 free sample lessons from the course. You don't pay anything for it. And so it's just so people can try it before they buy it and see if they like it or if they resonate with it or not. In there, I do something very unusual, which is I've given lifetime access to the community because what I really want to do is build a community of successful, thriving wealth builders who then go on and do cool things with their lives. And so we've got this amazing community of people. They're super smart. They're very involved. I mean, people that are involved today on the calls were involved, what, 6, 7 years ago when I started this whole thing. You'll hear them on the recorded calls from 6, 7 years ago, and you'll hear the same voices today. The reason they're getting enough value to stick around, right? They've had the course for a long time. They're still showing up for the community aspect
Yeah.
and to interact on the office hours calls, which I don't charge for. I'm in there every week that I'm not on vacation. If I'm on vacation, I cancel the office hours. Otherwise, I'm in there. And so you've got the community aspect of that course. That course is a master class, and it's fundamentally different from like everybody hears that they go, oh, it's a financial planning course. Oh, I know financial planning,
Mm-mm.
or oh, I've got a financial plan. My planner did it for me. No, 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 no. There's a quote by Eisenhower, which I'm going to redo the sales letter and build around, which is your plan is nothing. Planning is everything. Experience in war when you're planning, you're strategizing all the possibilities, the outcomes, how you use your resources tactically, how you go about it all. And it's your plan. You own it because you're the mind that created it. It's not like you passively got it from a planner, right? You learn the principles, you applied them into your plan, you have your plan. And I purposely do it. It's just a Microsoft Word document. It's like so lame, right? And the whole reason why is because it's yours and you have to interact with it because the way I teach it is it's not a set and forget thing where you put it on a shelf. You as your major assumptions change, you go back, you update it, you interact with it. It's easy peasy when it's your own document and you know what you're doing, right? And that's how you assure that you will have financial security. It works like a guided missile going to a target. I don't know the exact data, but something like a guided missile is off target 80, 90% of the time. And yet it hits the target with absolute precision. Why? Because it's correcting and adjusting the whole way to the target. That's
Mm.
what I teach people to do with their financial planning is you have
Mm-hmm.
to know it. That's the planning process. You know it. You own the plan. It's yours. You work with it. You know why it's true. You know what the assumptions are. Most people have no idea what the assumptions are in their financial plan. And they know the math, they know the principles, and then they go in and they can stay on track so their financial security is assured. So that's the expectancy wealth planning course. And it's the only course I know of that's built from the ground up on the math principles that determine your wealth, which is the expectancy equation and the future value equation. Those two
Mm-hmm.
equations will determine your wealth, whether you know it or not. And they have specific principles that you must apply in order to do it right. Otherwise, it's an inefficient process, which means you're leaving money on the table or you're taking more risks than you need to. So that's that course.
Mm-hmm.
Allocate Smartly is more recent. Okay. And so I don't have those courses finished. I have 2 courses half done and I plan on getting them finished over the next year. One is a whole indoctrination course that's going to be like an advanced investment strategy course that takes people from um, buy and hold investor, which I would call retail investor,
Mm-hmm.
to advanced investment understanding. So level up their
Mm.
knowledge so they can see what's wrong with their understanding, why it's not true, all the math anomalies, all the research, all the reasons why. It's all third party verified. It's not Todd's opinion. And then show the implications as to what that means for strategy and how you apply it. Right. And then the
Mm-hmm.
obvious choice is, of course, allocate smartly, which is the sell. Right.
Mm-hmm.
But you don't have to sell it. I'm going to give the course away, right? So you don't have to buy Allocate Smart if you don't want it. You can have the advanced training for nothing. And then for people that buy it with my affiliate link, That's how I get paid. If they buy their subscription to Allocate Smartly, my affiliate link, I will have an entire another course, which is all about how to get up to speed with Allocate Smartly. That was Smartly, and it answers all the questions. And where that came from, the reason I can say that is because I supported my community, Expectancy Well Playing. Most of my community members use Allocate Smartly, and I've been in there supporting them in the thread. It's almost 100 pages now. That thread is almost
Mm,
100 pages of me answering questions.
yeah,
So I have all the questions everybody's going to ask,
totally.
and I have the answers. And so it's all been compiled, it's done.
Do you
And
have an
so
ETA on that?
I'm incredibly slow. Is never perfectly happy, you know, like I'm the cog in the clog. I'm happy with what I always say is I would rather be good than fast. And
Yeah.
so it's hard to do them well. They're very complicated topics. And because they're contrary to conventional wisdom, they have to be done very well and very carefully and very well supported. Otherwise, it'll attract a lot of, they're going to attract a ton of critics anyway. Everybody's a critic,
Hmm.
right?
Hmm.
So they're going to attract a lot of criticism anyway because they're not mainstream and they're not saying the same thing everybody else says.
Yeah.
Because they say something different, they're going to get that. But it's only the well-founded critics I care about. The guys who
Yeah.
can say stupid stuff. There's a million of those on the internet.
Yeah.
So anyway,
Well, your your workshop, and I'm sorry, I'm not referring to it correctly, but I'm gonna that that is so well done. And you talk about the math, but what sticks out to me is you're talking about mindset, right? To making sure that people understand kind of what's underneath this and then why does it matter. And I would say to anyone who's looking at like this conversation and thinking I need to dive in, that would be the best place to start because you're going to get the resources and you're going to be able to ask questions as you look at Allocate Smartly. The other thing that I want to say is that people pay tens of thousands of dollars for to go hire, whether it be a regular advisor down the street or some very fancy expensive advisor who has all these rich and famous clients, and they are literally following a model. And what we're saying here today is the model is most likely not as good as what Todd has created. Like, I can say these things, you might not be able to, but like, it's crazy pants what we're talking about here. Like, you have made this so low cost and easy to do once somebody makes a commitment. And you and I had an email exchange, and you said it's not that it's hard or even difficult, it's that a lot of people aren't willing to put the time and energy that make the commitment that they're going to actually get involved in their finances. Is that fair?
first of all, regarding the course, let me just hit the course first. There's art and science when you're working with people, and this ties into your question. So just remind me of the question if I forget.
Yeah.
Okay. When you're working with people, I coach people for 2 decades, right? That's why I can be conversing on these topics, as I've been conversing on them for 2 decades. Plus, I spent all the years doing the research. It's art and it's science, right? The art is the human side of it, right? Humans are making the decisions. We aren't robots, right? We're not rational robots. There's emotions behind it, there's history behind it, there's belief structures, there's all these things. And so the course works with both. Even like the entire module 7, the seventh module in the course is now you have your wealth plan, so what? You have to implement it to get value out of it. And so the entire seventh module is all about how you restructure your life to maximize the amount of action you take on your wealth plan. And I even have 3 lessons right at the end that are all the troubleshooting from my 2 decades of coaching. Um, there's 3 lessons that go through and troubleshoot. If you're not getting the results you want with your wealth plan, you got your plan. I know it's good because you went through the course, you got to this point. So it's correct. And if you're not getting the results you want, then it's in these last 3 lessons, and it goes through and it troubleshoots, and it's all human stuff. All the things you as a human could be making a mistake with in your life, in your commitment, in your resistance, in all these different things. And so going down to your question, so it's both. You have to have the science, you have to have the math because you have to get it right. So you have to have the financial principles right. You have to understand the assets and the strategies and tie them back to your resources, your skills, your abilities. All those things have to be done correctly or your wealth plan won't work. That's why every wealth plan is unique to each individual, right? No two wealth plans in my course are the same because everybody comes in with different resources, skills, interests, goals, timelines. And so it all has to adapt, which it does, right? And yet we all share the same common foibles as humans in implementation, which is why there's only one module that covers that. So getting back to your question, I let me just say it, think I have it right. Why isn't everybody doing
I don't,
this? You know,
yeah.
I'm gonna be honest with you. I don't know why. It's a mystery to me. Like it's funny. Okay, so inside the expectancy wealth planning community, one of my students, he's a Google engineer, and so he's very quantitatively oriented, and he came from the fire and boglehead side of things, which, as you well know, is very staunch buy and hold and traditional asset allocation and save your way to wealth and all this. And Todd's throwing out all these things, and he's like, God, I was really cooking his, cooking his brain. And finally, I said, look, you don't get this TAA thing. I said, here's what you want to do. Use your programming skills. I said, pull the data from Allocate Smartly and create distribution of returns charts. And I did it to appeal to his scientific understanding. And he published them inside the community so everybody could get access to them, right? So he did these distribution returns charts and he went, oh my God, I get it. Like this is so incredibly obvious. And a whole bunch of other students, once they saw those charts, they could see it because what happens when you do TAA, tactical asset allocation, is you essentially transmute the distribution returns. So you take the distribution returns of buy and hold, because all you're doing is you're applying discipline risk management as an overlay to your buy and hold portfolio, right? It's using same low cost passive index assets.
Yeah.
There's nothing magical here. It's just bringing risk management to change the math of how this game works, right? So what it does is it transmutes the distribution of returns and it shifts the center point out to the right. So you have a higher percentage of favorable returns. You sort of flatten out the far right tail so you don't get those huge weird outlier wins that you get in buy and hold, but you get a lot of them, just not as many. But what you do is you completely cut off the left tail. So the left tail is just slightly to the left of zero, but it goes boom and it just falls down. You don't have that big fat left tail of the losses that you get on buy and hold. All those distribution returns get shifted out to the right. That's why it's so much more consistent. That's why it's more reliable. That's why it has higher percentage profitable months. All these things, like once you see it and you see what it's doing, you look at it, you go, this is obvious. Like it's amazing because people throw all kinds of craziness at it. They're like, "Oh, but you can't market time." But yet not one of them has ever thought, "What is market timing?" They've never defined market timing, right? They just use
Mm-hmm.
it loosely, right? It's a
Mm-hmm.
loosely used term. If you define market timing as predicting the future of the markets and positioning your portfolio to predict the future of the markets, then I 100% agree. You cannot market time. If you try to predict the future of the markets and position your portfolio to do that, you will fail. It's only a question of time. Nobody's ever done it. Okay. There's a few incredibly bright quantitative guys at the top of the hedge fund business, but even they have very disciplined methods to keep them on the right side of things when their judgment is wrong. So, no brain judgment here, no predicting the future. If you define market timing as statistically driven risk management, so completely disciplined quantitative risk management, then guess what? It works. It actually works. So, it has an effect of like market timing, but it never knows the future. If you look at the math of it, it has no predictive quality whatsoever. And yet it effectively cuts off the left side of the tail just from pure math alone. The very insight I had when I was a college kid in that class, I looked at that and I said, I can do that mathematically. And they said, you couldn't. Yes, you can. It works. It's worked. What am I? I'm 64 as we record this. So I've been doing this 42 years. It's always worked.
It's just so, it is mind blowing because I think that back to what you said earlier, like people with our money, people are like, oh, this is too good to be true. But yet they'll go and they'll invest in something that actually right now is too good to be true.
It has to do with the way people think. I mean, they're
Yeah.
thinking, hey, and I don't blame them, right? I mean, they're not investment experts. They have busy lives. They've got kids to
Yes.
raise. They got to get dinner on the table, groceries in, kids to soccer practice, careers to deal with, nasty bosses. Everybody's busy. They don't have time to become an investment expert, right? I don't blame them, right? But
Yep.
it's one of these things. You work hard for your money. You work even harder for the net effect of savings. Doesn't it make sense to put a little effort into managing that in a way that is correct, that is proven mathematically true? Now, what most people will reply is they'll go, yeah, but Todd, all the experts support buy and hold. Yes, they do. Guess what? It's valid. It has a positive mathematical expectancy over the long term. But what I've said is that the investment epoch changed, that we had regime change. And I said that mathematical expectancy, the expected return of your investments, are conditional. So within that very long term, there are 10, 15-year periods that don't work out well. And you can see it on any long-term chart. Look at any long-term chart of the S&P 500 and you will see it looks like a staircase. It goes up or it goes flat, up like a stair, flat for 10, 15 years, up like a stair, flat for 10, 15 years. It's been doing it forever. I'm not saying anything unusual. It just
Mm-hmm.
sounds unusual in the context of the times we're in and what's going on here. All this stuff is proven.
I remember before I made the final decision to I think I wrote to you and I said I'm not keen on staying with an advisor that I had been using and I wanted to take it on. And maybe this is the thing that people need to hear is that yes, it's scared at the moment, even with all my experience with finances, it scared me to like trust myself to do it, to stay with it, to learn it, to like get through the uncomfortable parts of it. Like I didn't
Yes.
know if I was going to be able to do it and what that was going to look like. And side note, I didn't do your models in the beginning. We talked about that offline. I did another model and I, there was so much activity. I felt like I was a day trader and like it was ugly and I still stayed with it, doing it, making the changes. The portfolio is doing fine, but it was a lot more work than I think what your model is
I'm
all about.
confused. How could it be like a day trader? Because it should only trade once a month.
It was sending updates and changes like crazy constantly.
Uh,
I don't know. It was horrible. Like
okay.
I think I needed to be fed to the wolves, quite frankly, with this really bad experience to like be willing to stay with it, even though there were just so many like, oh, we're changing today. Here's the model. And it's a retirement account. So it's okay. Like it's not as bad as it would have been if it had been a regular investment account. But we're going to just erase that from my memory. But all I can say is now looking back, it made me really, really tough. And like, I can do this. I'm going to keep showing up. I'm going to figure this out. And when I finally was like, okay, this isn't working anymore. And all to say, I took on more agency with my investing than I had ever planned to. And I feel like a far more empowered person at the end of the day because of it. And, you know, even though I've been in finance for 30 years, I've still been challenged. I lost a lot of money in the downturn in 2008 and 9 and was really worried about the markets coming back. And a lot of mistakes have been made. And so being willing to stay in something, even when it didn't feel like it was going well, made me really proud of myself that I could stay with it at the end.
Good
And
for
I feel
you.
tougher. And the portfolio is doing fantastic. And now I found your models. Nobody has to go through that because you just start with the best from day one. But I am just really proud of myself that I did it and I learned a lot.
Yeah, first of all, congratulations. Um, Good for you for taking it on. The word that really stuck out for me when you're talking was agency. I think that's the key distinction about people that do this versus people that don't, um, is that acceptance that if it's going to be, it's up to me, that I am self-responsible and I am capable. This is not rocket surgery. It's very achievable. It's all done for you. All the math's done for you. All the model updates are done for you. The data management's done for you. I mean, it's all on a 400 a year subscription. I mean, let's just play with a number, just round numbers, just for entertainment, okay?
Yeah.
Let's say you're running, I'm going to make up a number for you, 3 million. And let's say it used to be at a 1% advisor, okay? So that's 30,000 a year you were shoveling their way for effectively handholding,
Yep.
right? For a few phone calls, whatever it was. But there's not a lot of investment work being done for that. Um, so there's 30,000 a year that you have in your pocket compared to 400 a year for the subscription that does all the heavy lifting, and all you have to
Everything.
do is pick the models and update them once a month.
Yep.
And so it goes back to what you were saying earlier about crazy value. Like, you know, the whole purpose of the expectancy wealth planning course is I spent a lifetime learning this stuff. This was my give back. It took me 6 years to create that course. I got 6 years of my lifetime writing those lessons, building the videos, supporting the community, all that. And it's all there and it works. And it's a system. Like it's congruent, cohesive understanding of how this works as one single thing. And now I'm going to put a couple years into these allocate smartly lessons, right? But it makes it turnkey for people and it's 400 a year and you can do it for a lifetime. Your
Totally.
savings over your lifetime, now you're past that learning curve, that initial learning curve.
Yep.
You could take several vacations a year, highfalutin vacations a year off of what you save in advisory fees.
It's
And your
so
portfolio's
beautiful.
outperforming.
Right. Totally amazing. And I feel better about investing than I have in my whole entire life as a result of this model.
That's a
Hands down.
that is a common feedback I get from the people that are retirement or near retirement. Is it's the first time once they finally understand it. And again, the big breakthrough in the community was those distribution of returns charts, which eventually
Hmm.
I'll have in the education series. Um, for quantitatively or math or engineering minds, they look at that and they go, "Oh, duh, this is obvious." For
Yep.
everybody else, they can kind of make. They would tell me that it's the first time that they finally have confidence in their financial future. People who have spent a lifetime saving, by then they had been through enough market downturns that they knew they were one market downturn from having everything turned upside down.
Yep.
And they finally got that if they do this, they can weather the downturns. That doesn't mean they won't lose money. Models aren't perfect. There's no perfect
Mhm.
investment strategy, but they can weather the downturns. They can come back quickly. It supports their spending rate. And then I also teach them about guardrail models on their spending, which gives them an adaptive spending model. And they're looking at that and they're going, oh my God, this is totally going to work. Like,
Yep.
I get how this works now. For the first time, I understand how it's going to work. I have confidence in my financial future.
I know I'm grateful. I'm grateful for this conversation. I'm grateful that you were willing to share because, yeah, we have time inside of our relationship. I know you, I trust you. I just wanted to showcase you, what you've done, and for people to get a sense of like what's going on behind the scenes for my own investing and for many others who follow
Yeah.
you.
So, I mean, here's the thing for all the naysayers, right? Oh God, he's just a slimy, slick salesman or whatever, right? Right. The most you can spend with me, if you bought everything possible, the most you can spend with me is about 2 grand. 2 grand. And you'll get advanced investment strategy for free. You'll have an entire course and you'll have lifetime support. And the most you can spend with me is $2,000. Sources you get immediate access to. Like, so for all these people that are going to bitch and say, oh, he's a huckster and he's just got a course to sell and all this, spend 30,000 to a financial advisor who does almost nothing and will give you no education, won't show you how it works, won't move the needle at all.
100%. I'm just like kicking myself that I didn't do it sooner. But again, I'm like, I learned, but I don't, I learned enough. Now I'm doing it the way that I feel really, really good about. So thank you, Todd, for all that you do and for giving back. Cause I do feel like you could be doing all of what you're doing here in a completely different class of costs and time that people would have to, it's just, it's so accessible. And that's why I wanted people to know about it.
Yeah, if it was about max profits, I'd still be in the hedge fund business. They pay me a lot of money.
Yeah.
I don't make squat on this business. That's the untold secret. I don't make shit. Okay.
I can
Net of
imagine.
net of my overhead to pay tech guys and assistant and solve problems,
Yeah.
to give back the knowledge that I spent a lifetime developing. This is part of what I teach. It's called a deathbed exercise. I could not go to my deathbed without having tried this, without having given it everything I had. This is my give back. It's full circle. It's my community. Um, Everybody's telling me I should charge for it. They don't understand why I'm giving this support for, they've been in there for years and I've never charged them a dime. And it's
Mm,
because they're active parts of my community. I value them. I want a community of thousands and thousands of wealth builders that are making a difference. And
mhm.
that's success.
I feel that. I'm grateful. Thank you. Thank you for all you do. Thank you for helping me personally. Thank you for my husband as well, because he's like, at first, he was like, "What are you doing?" I'm like, "I don't know." And now I'm like, "I've got it. I figured it out. I've got Todd's model. I'm good now." So it's all good. And I'll never look back. So thank you. Thank you. Thanks for this conversation. We'll put all the links for everything for them to find you, get on your email list, get the class, get allocate smartly, smart, allocate smart.
Yeah, the
Ah,
one I'm going to give you
okay,
verbally because it's not actually on the website. So they can
perfect.
find my course on the website. The Expectancy Wealth Planning course, you just go to products. It's right there in the products. You can't find the Allocate Smartly on the website. You have to know where it is. And so it's financialmentor.com/invest. So
Financialmentor.com/invest.
invest, and that will take them to the sales page for that. You have to go through the sales page to use my affiliate code to get access and get all my stuff for free. And so that
Perfect.
one you won't find on the website. So you have to know it. And that's why I'm giving it verbally.
Perfect. Okay, we'll also write that down. Thank you. Thank you.
Thank you. Appreciate it. Thank you.